Hello, and welcome to the next series to make you a financial markets trader. In this session, we will be looking at an introduction to market analysis. All right, market analysis. Now, let's look at this as a way of introduction. If you're going into any business, okay, any business, even studies, whatever you want to do in life, there is need for you to conduct a form of research to know if there is viability in that business or what this endeavor. Now, when it comes to the financial markets trading, we have what is called market analysis, and this is what we're going to be looking at. When it comes to the business aspect, of course, you have to conduct what is said to be something like a SWOT analysis, where you're checking out the strength of the business, the weakness of the business, the opportunities and the threats. Now, when it comes to the financial markets, you have to conduct market analysis. All right. So let's look deeply what market analysis means when a trader wants to trade the Forex market. Now, the Forex market, in the financial market, understanding market analysis, it says, as the name implies, it refers to the study of the different phases of the market that can affect your trades. So you do not just trade blindly, hoping that all things will work out well. No, this is not the way to trade. You have to know what factors have the capacity to influence your trade and to push price either to go in your favor or to go against you. This is what we are looking at, and that's why we call it market analysis. So what are the phases that we have to study? Number one is called technical analysis. I'm talking about the different phases of market analysis when it comes to Forex trading. We have what is called technical analysis. We have what is called fundamental analysis. We have sentimental analysis, and then risk or money management, okay, or risk analysis. Let's put it as short, risk analysis. Now, all of these factors, all of these sectors, they have a capacity to influence your trade. So a trader must do a holistic analysis of all of these sectors, else it's just like sitting on a tripod stool and one leg breaks off. You could be getting yourself in big pitfalls if you do not conduct proper market analysis in the order that I have shown to you right here. So let's look at them one after the other and get you properly familiar with these terms, because from here we will be building and building until you become very familiar with the financial market. So let's look at number one. What is technical analysis? What is the definition? What is technical analysis? From the definition on your screen, it says technical analysis is the framework in which traders study what? Price movement. It's in bold, it's emphatic, price movement. That is through the study of past market data, and try to make decisions on whether to buy or sell based on this study. Now, you see, there's a reason for making an emphasis on price movement. Why should anyone just decide to buy or to sell based on price movement? It's just like saying, okay, I'm deciding to do something because you waved your hands 2 times, you know, that kind of a thing, you know, your hand moved up and down. So it's the same thing when it comes to the financial market. In technical analysis particularly, traders are looking at historical price movement, and they try to base their judgment based on what they can interpret on what those movements signifies. Now I'm going to break it even further down so you understand why this definition is so short, but yet it contains a lot of what do you call it? A lot of details is in this little definition that you can see. So let's start from price. What is price? Why should a trader just look at price movement and try to make a decision to buy or sell? The first answer comes by defining price, and I'm going to define it in the way a forex trader should define price. Okay, I'm not talking about the economic definition of price now. Now, in forex trading, price is a derivative of demand and supply. Okay, price is simply a derivative of demand and supply. As a forex trader, when you're looking at price movement, all you can see is that when price is moving up, it means more people are demanding or buying that particular asset. Okay, and when price is going down, it means that people are not willing to hold on to it, they are selling off. So price movement on the chart is basically a derivative of demand and supply. Now, the next question is this. What is it that, who are the major players that determine what demand and supply? Don't forget, we had the major 4 drivers of price. Don't forget that. If you remember in the series 1 video, we talked about the 4 major drivers of price. You know, health of the business. We talked about the CBN, that's the central banks. We spoke about that's monetary policies, fiscal policies, and then politics, either national or geopolitics. Now, all of these are majorly dominated by humans. All right, humans are the major players in all of these 4 drivers. Now, in human decision, why are they making decisions, you know, that will either affect demand or supply? These decisions are all made based on 2 factors again, and that is based on risk and reward. So let's break it down again. So traders take a decision to buy or to sell based on the derivative, based on supply or demand, because price is a derivative of supply and demand. Now, who are the major players? Who are the ones that determine to buy or to sell? They are not inanimate things. It's not plants or houses. No, they are humans. And humans are making this decision to buy or sell based on 2 factors, risk and reward. So if there is a reward potential in it, people tend to buy. If there is a risk factor to it, they sell off. Do you understand that? Now, this is simply why the definition is so short, but yet contains a lot of information in it. And that's why I'm taking my time to break it down, so you understand when we get to the part of introducing you to technical analysis properly, you will get to see how these things all play out. Now, let's talk about, you know, crowd control. Why this is why this definition also plays out really well, and why you should. Let me try to break it down so you understand even further. Now, when people are trading in a group, it is easier to speculate or predict how they will behave. Okay, it is easier to predict how a crowd will behave in a crowd in a controlled experiment. Now, this controlled experiment I'm speaking about, I often use this example. Okay, take for example, in a hall, in a big hall. All right, in that hall, maybe you have 100 people made up of different professionals, from a teacher to a policeman, you know, to a doctor, to an astronaut, an engineer, you know, a fire service official, whatever, you know, different officials, and there are different professionals, and there's just one exit in that building. Okay, follow me on this example. So in a hall, 100 people, one single door of exit, and it's at the other end of the hall. Then you have on the other end of the hall, suddenly there was a fire outbreak, an explosion, okay? And the fire is inching closer and closer to consume everyone in that hall. Despite in that number of people, there is a fire service personnel, you know, and all types of professionals. Now, studies have shown that it is easier, everyone can walk out of that room if they could file on a straight line. Okay, if they could file up on a straight line. But studies have shown that in such a case, everyone will rush at the same time towards the door, and there will be stampede, and there will be all sorts of chaos there. You see, so this is the same thing when it comes to the financial market. In the financial markets and in forex trading, okay, when there is a risky event, it is easy to tell how people are going to react. Don't forget, people react to price, to demand and supply based on two things, risk and reward. So once there's a risky event, people tend to just sell off immediately. So it's easy to predict that once a risky event has occurred in any part of the world, in any part of the economy, people try to sell off. And once there is an opportunity that is reward, people go in to buy. So this is it. So in a crowded environment such as the forex market, it is easy to predict how people are going to react to two major factors, risk and reward. This definition, we're going to use it over and over as you trade the forex market. Okay. Now, technical analysis can also include the studying of price charts on the trading platform, making use of technical indicators, performing a wide range of possible actions with the trading platform. All right. I hope this is sinking in deep as it should be. Now, let's look at an example of a chart. All right. Now, I know this is your nightmare, but don't worry. I'm going to break it all down for you. Okay. So here we have a simple chart. Okay. This is a price chart, and you can see that. Let me pick up a writing tool here. Okay. Let's see. So you can see how price has been fluctuating from a level. It went down here, then finally came up, came down again, went up, went down, go up. So you can begin to see why forex traders, that is technical analysts, in this case, let's break it down or limit it to technical analysts. You can begin to see why technical analysts, why we define technical analysis as a framework in which traders study price movement and try to make a decision based on that movement. So if you take a look at this, you will find out that price has, price gets to a certain level and it doesn't go above that level and it starts dropping. So let's assume, let's go back to the beginning. Let's start from the very beginning. So let's assume price went up from here, 0.1, or let's call it A, all right, and went up to B, all right. Then from B, it dropped again to A2. Okay, let's assume this is A1. Okay, so in dropping down to A2, why did it get to the point of A2 and didn't move further down? There is a reason for that. Now, price moved from A2 and moved up to B2. And a technical analyst will look at the chart and say, wow, why did price get to A1, this point in A1, and stop? And going up, it stopped at B. Well, no historical value to prove that. But in coming down, it reached the same level as A1 and stopped. Why is it so? Now, in going up again, in rising up, it got to the same level as B1 and stopped and gave us B2. When this kind of thing has happened, what do you think? How do you think a trader will interpret it? Humans are emotional and humans are highly predictable, especially if you have studied them for a longer period of time. Okay, so if you stay with your friend, you can actually predict what that friend of yours can do in certain conditions. So this also applies to the financial market. So let me put it in perspective now. So we define price, a derivative of demand and supply. Yes. Now, and so demand and supply is majorly initiated by humans, and humans are driven by two factors, risk and reward. And humans are emotional beings that often tends to repeat history based on their nature, because nature has shown that if a man is faced with a lion, he will run away. And if he's faced with an opportunity to make money, he will do all he can to grab that money. So humans are highly, highly predictable, and their emotions play out on the chart. So when a trader is looking at the chart, what he's saying is that, oh, most of the world traders see an opportunity to buy on A1, all right? And when price has risen to B1, they have made profit. Maybe they bought from A1 at $1, okay? Let's assume, just use small figure. They started buying these assets, okay, at $1. and it's got to B1, maybe $2, and they are happy to sell again. So they made profit of $1. And when price began to drop from B1 to A2, when it got to A2, traders will look back in history to see what has happened in the past. And they see that, oh, when price got to A1, the world saw that this is the cheapest price, this particular asset, this is the best place to buy it. This is the best price to buy it. And what happens at A2? From A2, buyers begin to demand for this asset, seeing that historically, this has been a perfect place to buy it. And what happens? They start buying again from A2. And elementary economics says that the higher the demand for your asset, the higher will be the price. So from A2, when the more people are buying into this asset, price rallies up to B2. On getting to B2, they look back in history. Oh, wow, many people, sold at this point. They took profit because maybe they believe that $2 is the highest price that these assets could get to. What happens? As soon as they start selling, the price starts depreciating again, and it drops to a level again that we can call A3. Okay, A3. So when it gets to A3, new traders or old traders who have been trading this particular asset are looking back in history to see that, oh, at A2 and A1, this was the best place that many traders decided or chose to buy these products from. And demand increases again, and you start seeing the rise in that price again. And it gets to where? B3. And before you know it, we have a drop. And maybe in this case, maybe there is a fundamental factor somewhere. Maybe it's a product that the government has decided to ban entirely from the country. And, people do not believe that, this is a good product to put their money into anymore. After all, the government has banned it. And you can see that price continued to descend even lower. This is how Forex traders interpret the charts. And that's why that definition you saw, very simple, very short, but yet in it is a lot of information. Okay, in it is a lot of information. So don't forget, history often repeats itself. Why? Humans are emotional beings. They often tend to repeat what they have done in the past. And that is why when Forex traders look at the chart, they decide, based on historical movement, it is best I buy here or best I sell from here. So this is why in market analysis, you do not analyze the market using small time frames. You have to start from a bigger time frame, all right, to see the historical movement of price. Anyway, we'll be talking more of this when we get to trading strategies in the next series of videos ahead from this one. Okay, I hope you got clearly this definition and what technical analysis is all about. Well, we said market analysis comprises of 3 to 4 sectors. This is just one of them, technical analysis. Let's move on to fundamental analysis. Okay, what is fundamental analysis? From the definition there, it says fundamental analysis is a way of looking at the Forex market by analyzing economic, social, and political forces that may affect currency prices. So this has nothing to do with price movement. We're just looking at fundamentally, is there a political instability in that country? All right, are there social unrest, environmental catastrophe? These are fundamental factors that we're talking about. So when we're looking at fundamental analysis, you're looking at news. You're looking at news channel, watching news channels, trying to get news that has the capacity to affect that particular currency, which reflects the economy of that country. All right, that's why we say currencies are ambassadors of their country. So when anything fundamentally happens to an economy, it reflects on the ambassador. All right, and that is the currency. So this is fundamental analysis. We're going to be looking also how to read news in the market. Now, next one is sentimental analysis. Now, sentimental analysis is simply trying to gauge the type of traders which is currently dominating a particular market. And when we talk about particular type of traders, you see, the forex market is always a game of two. Two things are always happening. All right, it's either you're buying or you're selling. Okay, it's either you're a bull or a bear. So when we talk about sentimental analysis, we're referring to what kind of traders are currently dominating the market. Okay, so a market with a strong upward movement is said to be dominated by the bulls. Okay, when we talk about strong upward movement, we're talking about price is appreciating, the price is rising and rising. So it means that people are buying and buying. In the forex market, buyers are called bulls. Okay, but when we see a market that is dominated by strong downward movement, we said that the bears are in control, meaning they are sellers. Okay, bears in forex market are sellers. So whichever type of traders that is dominating the market, that is the direction that the market will go to. So if we have more people buying, price will jack up. If we see here, we have more people selling in fear, price is going to drop. It's whichever percentage that is leading, that is the direction that the market will go to. Clear enough? All right, so the good news is this. When we're going to be looking in the next series of video, I'll be introducing you to the trading platform, the MetaTrader 4. All right, the good thing with this, I can tell you, is that through the MetaTrader 4, you can derive two. You remember we had four market analysis, technical analysis, fundamental analysis, sentimental analysis, and risk analysis. Okay, now all three, you can derive it from the trading platform. Okay, you can derive all three. All right, you are conducting your technical analysis on the trading platform. Through technical analysis, you can see what class of traders are currently dominating the market, that is sentiment. And on the charts on the trading platform, you can conduct risk analysis. Okay, if I sell from here, will I make money if it drops to this level? Or if I buy from here, how much profit will I make when it appreciates? And what if it does not go in that direction? So out of four, understanding the trading platform, understanding technical analysis, you are already 3 points ahead to winning and becoming a profitable trader. So this is the area we're going to focus so much on. I'm going to be teaching you technical analysis, sentimental analysis, and money management or risk management when it comes to the forex market. Of course, the fundamental analysis, there are lots of news sites you can get that from, such as Forex Factory, watching Bloomberg, CNN, to know what is happening in certain countries. So all of this put together, you are now ready to make your trading decisions. I hope you've gotten or understood what market analysis means in the forex market. So join me in the next video where I'll be taking you another step closer to becoming a professional forex trader. Thank you so much. See you in the next video. Bye-bye.